There are three basic fundamentals when you are looking to buy a home, and they are credit score, income, and down payment. In this video, we're gonna talk about how to increase your credit score so that you get the best rate and that you qualify for your first home purchase or your next home purchase. Okay, and just to give you guys an idea of how much of a difference your credit score makes when you're getting a loan, I'm gonna walk you through a couple examples, then I'm gonna go through all the tips, all the things you could do step by step to make sure you have the best credit score possible to buy your home. Okay, so here we have a scenario where you're purchasing a property with an FHA loan. Let's say you had a 700 credit score and your rate would be approximately about 4.5 to 4.625. This is an LA County 700 credit score, 800 purchase price, 3.5% down. You would be looking at a 4.5 to 4.6% rate. Okay, so if we were to change your credit score to 620 instead of 700, everything else stays the same for an FHA loan. So remember, we had a 4.5 to 4.625 rate. Now your interest rate is going to be 5.5 to 5.625 on a 30-year fixed FHA loan. So as you can see, your credit score makes a huge difference, 1 full percentage point. And if we want to compare the monthly payment, you would be looking at $5,100 with a 620 credit score, $5,131, and if we switch it back to 700, you'd be looking at about a $4,600 payment. So that's a difference of $500 a month on an $800,000 house with an FHA loan. That is a huge difference. $500 a month is $6,000 a year. Over 30 years, that's $180,000 in interest just by raising your score from 620 to 700. Okay, let's take a look at one other scenario if you're getting a conventional loan with 20% down. Let's say your credit score is 720 and you are buying a $700,000 house with 20% down. You would be looking at a 5.375% rate. Now again, these are all as of today, July 28th, 2022. These could change in the future, but the difference between the rates that you're gonna qualify for based on your credit score is not gonna change. It's still gonna be a huge difference. So 720 score gets you a 5.375. It's a $39 cost. Let's call that par, which in the mortgage industry means even. So 5.375, and you're looking at a payment of $31.35. Now we're going to change that from 720 to 660. Instead of a 5.375, you'd be looking at a 6.875% interest rate and a payment of $3,600. Again, about a $500 difference and about 1.5% higher, just 60-point difference. So if you went from a 660 to 720, 500 a month and 1.5% on your interest rate. That is a huge difference. Okay, so what can you do to make sure that you get the best rate and prepare your credit score when you buy the home? The number one thing you're gonna wanna do is have 3 open and active credit cards or lines of credit or car payments. Okay, so it could be any combination as long as you have 3 open and active accounts. I had a client in the past who came to me and said, hey, I have no debt. And I checked his credit and his credit score was 660. And the reason for that is because he had one credit card with a $1,000 limit. And he's like, yeah, I don't like credit cards. I don't use them. But his credit score was 660. And as you could see, based on the example we just showed, that's not gonna get you a good rate on your mortgage. So you wanna have 3 open and active accounts, and that's the bare minimum. If you have more, that's fine. You can have 5, 6, you can have 10 credit cards. Now, that doesn't mean you have to rack up a bunch of debt. Okay, so don't go running out and buying a bunch of stuff. Keep them open, keep the balances low. As long as you have 3 or more, that's gonna help build your credit score. The credit bureaus wanna see that you can handle multiple accounts. By having 3, 5, 10 credit cards, a car loan, whatever the case, you're showing them, hey, I can manage debt. So that takes us to our second tip, which is keep your balances under 30%. So if you have a $10,000 limit, keep it at $3,000 or lower. That's kind of the golden number that you want to keep your balance under. You want to keep it under 30% of your available credit, and that's going to help raise your score because again, that's showing the credit bureaus and showing the mortgage companies you know how to manage debt. You're not overly dependent on credit cards, and you're doing a good job of keeping it at 30% or less. So our next tip is going to be never miss a payment. It seems very simple, but even I have made this mistake myself. Many years ago, I would just wait for the bill to come in the mail. When I would get the bill, I'd go online and I'd make a payment. Something happened, I didn't get the bill, or I must have missed it. I missed a payment and got dinged on my credit score. The easiest way to avoid this is always set up auto pay on all your credit cards for the minimum payment. That way you can easily avoid this, never have to deal with a missed payment, because it's happened to me. Things get lost in the mail and you just want to be safe, because one missed credit card payment can dock you 20, 30, 40 points on your credit report. Okay, this is another good one, guys. Always keep your credit cards open. Again, I've had clients in the past, this is the story. They go, oh my God, I was in so much credit card debt. I finally paid off the credit cards. It felt so good. I closed the account because I just didn't want to go into debt again. Again, closing credit cards will hurt your score for a couple of reasons. Number one, you're showing the credit bureaus and you're showing the mortgage companies you can't handle a credit card. You could not manage a simple credit card to the point where you had to close it. And the second reason this is going to hurt your credit score is because having a credit card open for a long period of time affects your credit score. When you have accounts that are open for a long period of time, that builds credit history and raises your score. So if you have a credit card, and again, you could start when you're 18 years old, you can open a credit card. By the time you're 25, you've built a very, very long history of credit. And again, you don't want to be maxed out all the time, but the longer you keep accounts open, the better it looks on your report and raises your score. Okay, this is another one that I've come across so many times with my clients. You never want to co-sign for anyone. Your spouse might be the only exception, but anyone else other than your spouse, you don't want to co-sign on any credit cards or car payments, okay? So I know it's tempting. You want to be a good person. People have said to me, oh man, well, this person, my cousin, he needed my help and I have a good heart. And this is a lesson that my teacher has taught me. People say things like, oh, I want to follow my heart. I want to do the right thing. That's fine. You can follow your heart, but take your brain with you. Okay, I get it. You want to be a good person, but if someone's asking you to co-sign, that probably means they're not in the best financial situation anyway. And again, I've had this happen where I pull a client's credit and there's a credit card that hasn't been paid in months. And I ask him about it and he's like, I don't know anything about that credit card. I don't even know what that is. He comes back to me a day later and says, oh, that's right. I co-signed with one of my cousins. He was going through financial trouble, not making the payments. And now because you co-signed, that's going to smash your score. If there's 4 or 5 missed payments, and someone's going through some kind of hardship, your credit score is done. And now what are you going to do? Now you might be forced to lend this person money to pay that off to fix your score. All of this happened because you had a good heart, you wanted to do the right thing, but I advise against this because you got to look out for yourself first and foremost. So follow your heart, but take your brain with you. Okay, one more thing I want to mention to you guys is definitely check your credit score once a year. And the reason for that is you just don't know what could have popped up on your credit report. You want to build a relationship with a mortgage professional or anyone else that could check your credit, because when I check your credit as a mortgage professional, it's very different than you going on Credit Karma. It's not the same. Credit Karma is not a complete credit report, and I'm the one who's going to be submitting your mortgage to the bank. So that is going to be the most official credit report that you can ever get. And it's going to show a complete history of everything. Again, I recently had a client who canceled their Sprint cell phone bill and I guess missed their last payment, and now they have a collection on their account from Sprint for like $100. So because of $100 payment to Sprint and she was not aware of, now her credit score is dropped. You got to pay that off. You got to get a letter and we got to update your score. So that actually takes me to another point. The other reason you want to contact a professional like myself is because we have tools that are not available to most people, and they are called credit simulators. So I'm going to show you guys what a credit simulator looks like and how I can help raise your score 40, 50, 60 points or more. So I'm going to use my credit report as an example. This is my official credit report. I don't think my social's on here anywhere, so I'm safe. As you'll see, under each score, so this was actually a couple years ago, but anyway, under everyone's score, when I pull your credit, I get this little number. It says plus 45, plus 5, plus 18. Okay, so what is that? That means my experience score could be raised by 45 points. My TransUnion could be raised by 5, and my Equifax can be raised by 18 points. So this is the simulator that I'm talking about. When I click this button, it will give me direct instructions on what I need to do to raise my credit score. So I'm going to show you guys a couple examples of what this looks like when I actually click this button, and it tells me exactly what I need to do to raise my credit score. And sometimes it doesn't even cost you any any money. You don't even have to pay anything off to raise your credit score. So let me show you an example. So I have this client here. I've whited out all their private information. He can raise his score to 620. I believe his score was about 550, so it's pretty low, but he can get it to 620. 97% likely is if he takes these steps, he will raise his score to 620. He doesn't even have to spend any money, $0. There's 3 accounts that he is authorized on. So again, he's co-signed with someone. Just by simply removing his name from that account, his credit score is going to go up to 620, a 97% likelihood. All he has to do is cancel access as an authorized user. So have the primary account holder, which is the other person, the person he co-signed with, contact the creditor and remove you as an authorized user. So you call up JP Morgan and say, hey, I want to remove so-and-so off of this account. You get a letter, you give it to me, boom, I raise your score. And you get this for all 3 of the accounts. Your score is going to go up to 620 or higher, and there's a 97% likelihood. So every time I have done this and there's a 97% likelihood, it has happened. Okay, so example number 2 of exactly what we need to do. So another client of mine, all he needs to do is pay off $219 of debt and his score is going to reach 640 or higher. So this client, I believe, was around a 615. Going from 615 to 620 is 1 tier, and then 640 is another tier. So going from 615 to 640, that's 2 tiers that he's going to improve his score. And it's telling me exactly what I need to do. This one card here, he needs to pay down the balance from $1,011 to $851. This account, he needs to pay down the balance from $3168 to $3108. 2 of these together is $219. So this is exact instructions of what he needs to do to raise his score 2 tiers. When you have someone like me, a professional, doing this, you get more direct guidance. You're not just paying off things willy-nilly, especially if you're tight on cash and you only have a few extra $100 and you want to raise your score as efficiently as possible. These are tools that can help get that done. With just $219, we're able to raise his score 2 full tiers and get him a better rate on the mortgage. So that is it, guys. Thank you guys so much for watching. If you found this video valuable, hit the like and subscribe button. I'm going to be coming out with videos every single week, helping homeowners do everything they can to land that dream house. So thank you guys again. I'll see you guys on the next one.